U.S. markets are sharply lower today, causing investors to worry. Is this the beginning of a stock market crash? Where does it potentially go from here? How can investors potentially prepare? And how can they even benefit from this economic climate? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. We're going to cover all that and more in this video. Let's first start off why the market is selling off, sort of the high level news. So first of all, earlier today, you did see core inflation coming in a little bit hotter than expected, around 3% worse. I would say consumer sentiment is expecting worse inflation later this year. They're talking about how inflation over the next 5 to 10 years, the expectations are that it might run closer to 4%. So this is the concern. This is a noticeable spike relative to the last few decades. This is partly due to concerns of maybe, tariffs could result in a price hike. You're even seeing it with Lululemon shares down around 14% today as they talk about how inflation is hurting the consumer, resulting in weaker sales as the consumer has less that they can spend on attractive yoga pants. But I would say the market is sending a different signal. So yes, you are seeing these concerns about inflation, but what the 10-year U.S. Treasury yield and shorter U.S. Treasury yields are saying is actually it might be a growth concern. It's less about inflation, more about potential economic contraction, because today the U.S. 10-year Treasury yield actually dropped by about 10 basis points or 0.1%. And you're even seeing this from the Federal Reserve, the Atlanta branch, saying, yeah, economic growth during the first quarter looks to be down quite a bit, looking around a 3% real economic contraction, even adjusting for, let's say, trade imbalances, the flows of gold. They're still expecting around 0.5% real economic contraction in the first quarter. So this is a real, in my opinion, sign from the Federal Reserve saying, yes, economic activity is expected to contract. And you are seeing this once again emphasized by market signals. While treasuries are getting a bid higher year to date, junk bonds are getting a bid lower, which does reinforce that investors are starting to say, hey, I want to own quality, not necessarily just reach for the highest yield. This could reinforce the perspective that we might be heading in for an economic contraction, because if there's an economic contraction, you do not want to own riskier bonds. You want to own, even if the riskier bonds have higher yield, investors are starting to say year to date, they would rather own and bid up the safer securities like U.S. Treasuries. And so that's the perception you're seeing. But it is important to understand the market really is just barely down. If you look at what's gone on so far, even including today's around 2% drop, the S&P 500 is only down around 5% year to date, and the NASDAQ's only down around 8%. This is far from a market collapse, and it is worth understanding that the U.S. indices are still quite expensive. The S&P 500 trading around 23 times earnings, NASDAQ around 29 times earnings. If you look at prior market bottoms, the valuations tend to be much lower, talking about a low teens type of earnings multiple where these could bottom. This does suggest that if this is indeed the beginning of a market downturn, which I suspect it could be, then you could have a lot more to go because the markets are still expensive. They clearly aren't as expensive as they were a few weeks ago, but they are far from bargain territory. Now, you can still find individual stocks that are bargains, but on a whole, this is not, deeply compelling prices that I think you could see. So that's the high level in terms of why is this happening. The next question is, how can you prepare? And then we'll talk about how can you prosper from this. So how can you prepare if indeed this is, a stock market crash that, could be happening, or even a recession that's beginning? First of all, it's super important, not only for you, but also the investments that you consider that you manage your debt. Oftentimes, and this is the reason why I'm showing a picture of a bank that says closed for business. Oftentimes during a recession, what happens is the lenders and the capital markets, they freeze up. And that means if you expect to roll over your debt, you have a maturity in the next year or two, all of a sudden that bank might say, I'm less certain, less confident that I want to make that loan. Perhaps it's because they have their own cash, situation where they have a deadbeat customer that refused to pay. So if one deadbeat customer refuses to pay because there's a recession, because the government's, cutting back on their spending, and then, someone's not able to pay their loan, and then the bank feels less comfortable to make new loans, you could see this type of spiral happen. It could definitely begin to happen with an economic recession. So it's important to check yourself as well as your investment holdings. When you look at your portfolio, look at the debt profile of your holdings to see how much debt do they have that's due in the next year or two. Could that be a problem for this business? If it is, that could create real pressure for the stock if the banks say, hey, we're closed for business, and they're saying, hey, how do I refinance it? So this is super important for you to think about before you see the closed for business signs. The next key aspect, and I think this is super important to consider, is liquidity, having cash. Warren Buffett sitting on a throne of $300 billion in cash. I personally am sitting around 17% cash plus a lot more liquidity when I think about the amount of borrowing that I could do from Interactive Brokers, which has very low, I think the lowest rates in terms of margin borrowing that I could consider. And personally, I would be willing to go up to maybe 130, 140% of my portfolio all in if I were to find, just overwhelming amounts of bargains. I don't think we're there yet. It's something that I'm mindful of in terms of my total liquidity. So my total liquidity, I would say, is probably around 40 to 50%. So lots of buying power if I'm right. And indeed, this does get a lot worse over the next few months or next year or two. So I think that is super important to consider, is not only do you need to manage your debt if there is a recession, if there is this market crash, but you also need to have the liquidity to prosper from it. Because if you don't have the liquidity, you're all in to start. It's much tougher for you to say, hey, when these unbelievable bargains do come, you can't act on it. So that is important to consider, is to have either some cash flow coming in or to have some existing liquidity. Now let's talk about how do you potentially make an opportunity from a stock market crash? How do you make the opportunity, from a potential recession? First of all, as always, this is not financial advice. And also, quick plug, recently Matthew, a premium member of the Unrivaled Investing community, he shared the following: Netflix, Spotify, and Unrivaled are the only subscriptions I'll never cancel. Seriously, this is an incredible value, and you've helped me and my wife comfortably take time away from work to travel and had the financial confidence to start a business of my own. This follows Santosh, another member of the Unrivaled Investing community, saying this was one of the best investment decisions I've ever made. If you're looking for compelling ideas, come check out Unrivaled Investing. By the way, I do expect to be raising prices later this year, so now is the time to lock in the most favorable rates that you can get for Unrivaled Investing. I think one of the things investors can do is they can always check for a second opinion. So I'm one of the co-founders of this company, flash.stocksentinel.ai. You can see the link below. This is leveraging AI to analyze individual stocks. So if you want to have a second opinion, completely free to use. It only costs if we don't have a company on there that you want to look at. Otherwise, it's completely free. That gives you a second opinion. And so it gives you something to think about if you're looking at individual holdings. So that's flash.stocksentinel.ai. There's also a podcast for each stock. So I think, when there's chaos, when there's calamities, you do want to have, that voice of reason. And so having AI sort of, give you its thoughts, even if it's overly optimistic or pessimistic, you're going to have to think for yourself. It gives you some data points for you to think about. And so looking at, what's going on, I think that this is probably one of the most important takeaways from this video, which is that the biggest danger isn't the crash itself. It's your reaction to it. And that's the reason why you could see videos, and Warren Buffett has actually talked about this for years, which is that if you will panic sell, if you will sell because in reaction to market dynamics where all of a sudden the stock is down 30, 40%, that causes you to sell, then you shouldn't own stocks. That is something Warren Buffett has said. If you're just going to panic, don't own it. So you need to think about what your behavior is going to be. If you can't handle the volatility, if you can't handle the stress of looking at your portfolio, get inch away each day, get knocked lower in a potential recessionary environment, then don't own stocks. Warren Buffett has said so himself. But if you have the psychology where you could say, yeah, I can stomach, I could stomach this volatility. I can stomach this sort of uncertainty, the pain that goes with seeing something go from 100 cents on the dollar to 80 cents to 60 cents on the dollar. Then welcome aboard and recognize that that's how fortunes are made. And I think during this process, during this chaos, it's super important to keep a level head. So for me personally, that's about keeping a repeatable process. That means having management that's aligned. That means that either they own a boatload of stock or they have very clear shareholder-friendly policies, a compelling valuation. This is, I'd say, the third line item's probably one of the most important aspects of this, in addition to aligned management, but obvious growth potential. I think what's going to be, the game changers in the years ahead is going to be the companies where you go, yeah, there's economic stress right now. There's a potential recession, but the businesses that are going to do really well are the ones where you're saying 5-10 years from now, it is just so obvious that this business is going to be much bigger, not only because they're growing now, but because they have a playbook for rinse and repeat. And it's important for you to recognize that, because a lot of people get lost up in this has a lot of potential, but their sales stink now. Focus on the rinse and repeat. At least that's my personal approach. Look for the companies that are already delivering it, that are already saying, yeah, here's how we're growing 10 to 20% this past year and why we think we can keep doing it. That's personally, my own personal approach is look for the ones that are already proving it out versus just the pie in the sky with this obvious growth potential where management spells it out for you, makes it super easy for you. And so I think this is the last, and I want to leave this, for you to think about. I truly believe that the next 2 years can offer life-changing opportunities in the market, because I believe we're going through a reset, particularly because you're seeing the new presidential administration, and they're not saying that they care about the stock market. That is a big difference than Trump 1.0. This new administration, very different. It's focused on getting yields lower because they have a very difficult debt burden that they need to refinance. So that is a key aspect that investors need to understand. They need to focus on lower yields. Lower yields might mean lower economic growth. And so lower economic growth, that could also mean recession. That could get lower yields. Hence, they're able to refinance a very tough debt burden. So I view this as, if you do go through that recession where you're not getting support from a presidential administration, and by the way, inflation's still so warm that you're not getting support from the Federal Reserve, that is quite unlike anything we've seen in the last few years, possibly the last few decades. That could create a real, I'd say, bottom floor opening up where you see asset prices much lower. That combined with the fact that valuations are not cheap. You could still find things that are cheap, don't get me wrong. For example, you can find stocks trading at 10 times free cash flow where they're buying back their shares and they think they can, grow significantly from here. You can find those businesses. I personally call, what the ones I find to my subscribers at Unrivaled Investing, and I have exclusive monthly video. Let me give you an example, because oftentimes people push back. So one of the 5 companies that I called out to my subscribers this past month. So I oftentimes, have a various different degrees of risk spectrum, from the more risky type of things where I'm saying, hey, this has tremendous upside, to the lower risk profile. So I'm going to talk about one of the ones that I own, in full disclosure, that's lower risk profile that I own. That's a company called Philip Morris International. And, subscribers have watched me buy it around 100, then around 120. So that's a company that I would like to add to. I called it out. Very simply, 3.5% dividend yield, very stable business, as you have a lot of users using nicotine, tobacco products, very repeat business. Even in a tough economic recession, people say, hey, I need my fix. And by the way, they have a new smoke-free product business that's growing very quickly. And that's resulting in management saying, hey, we've gone from a business where our underlying volumes are declining each year to now expected to grow each year, plus the ability to have pricing power, which they have. And so then you're talking about a business with a 3.5% roughly dividend yield, plus the ability to grow earnings around 5 to 10% per year. So that's the type of formula where investors, even in a tough economic environment could still be penciling out, let's say 10% plus type of returns over time. That's how I'm personally thinking about it. Now, that's just one of the 5 ideas that I called out to my subscribers. I'll be looking for more like that, and I'm personally in the market to buy more Philip Morris if it were to sell off. I'm just sharing this as one of the examples, as folks are, oftentimes, well, what do you mean? Give me an exact example. So once again, I believe these next 2 years, especially if you do get this tag team of a recession, shocking folks, causing folks to go, wait a second, you can get much lower valuations. If you indeed get much lower valuations, creates this opportunity for investors to go, wow, can I buy, these assets at really compelling free cash flow yields? And, when that happens, that's also my own personal backstories. During the great financial crisis, it was buying, a handful of positions, but one in particular where I put 30% of my assets that went up 5x during the next year. And it was during the financial crisis when the stock literally dropped 70% in a day. These types of opportunities can happen. And I hope that you're prepared for it and you're ready for it should it happen in the next year or two. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.